Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Friday, August 15, 2014. So you're looking at a daily chart of the SPY, right? The mirror image of the S&P 500. And we're getting pretty good at this. So what happened today was we actually pushed higher early in the morning. Actually, let me flip over to the 10-minute chart to show you the intraday activity. So we gap up at the open and we push a little bit higher, and then all of a sudden the markets just collapse. Of course, it was news on Russia. We all know about that. But how is it that day by day I'm kind of able to tell you what to expect in the market? And it's almost like I either know what the news about Russia is going to be, or do I know about the market? Well, I don't know which one comes first. Is it the chicken or the egg? But the interesting thing is, and that's not even the most important thing for today. But the interesting thing is, this was a technical correction, right? So what happens is we hit, let's go back over to the daily chart, right? So we hit the level that I said we would hit, which is this gap window here, the high of this day, this big down day, this big red bar. The high was 195.78. I said we were going to go into that number, so we pushed a little bit through it. We went into the 50-period moving average. It was close enough, right? And then all of a sudden, what happened today was it just reversed, right? We reversed back down. But what was interesting was, and here's what I want to get to, this is the reason why you can't be really short this market that much right now. Now, I know my members have a couple of shorts out there, but we've already taken profit on half, all except one, and we have stops on the others, and so it's not a problem. However, between now and Labor Day weekend, the most likely scenario is you're going to see more light volume than not, even though today was pretty good volume. And the volume came in, today's volume was, what was the number? 139 million shares on the SPY, 140 million shares. So the volume picked up when the market went down, but you just can't expect heavy volume between now and Labor Day, other than a couple of days here and there. So what I'm suggesting is, based on, I just want to flip back over to the 10-minute one more time. Based on the action here, so the market got defended down here at this, on the 10 minutes, a 200-period moving average. So it's defended, and then it just kind of floated higher for the rest of the day, and basically just about close enough to the flat line. And what that tells me is that I just don't see the market going down anything significant between now and Labor Day. That's just experience again. That's just the probabilities. Now, anything can happen, but the probabilities are they're probably going to float the market higher. So where does that take us? So if they float the market higher, next stop is going to be here. Okay, just call it 197. That's the next level of resistance that we'll see. And if we can get through 197, they're going to make a new high in the SPY. They're going to make a new high in the NASDAQ, which is going to be 4,500. And Apple's going to be over 100. And a number of other things are going to happen. LinkedIn's going to be 220 or whatever LinkedIn's going to be. And Facebook's going to be 75 or 80. That's just the way it's going to play out. And everybody's going to get their bullish pants on. And then, the market's going to pull back again. And then we'll see what happens from there. And however it plays out will determine what the pattern tells us it's going to do. But that's kind of the way I see it playing out. And, we're going to stick with this now because, we've been pretty accurate here, both on the way down and on the way back up. So I'm going to stay with what's working for me and what's working for my members, which is, the analysis that I'm doing is working. So we're going to stay with it. Let's go over to the gold chart. And, I've been saying that we're not ready. Time and price. Well, guess what? Time and price isn't ready yet. Today was a down day in gold. GLD was down 83 cents. I think the price of gold finished down maybe $10 or something like that. Anyway, So I'm not ready to buy it yet, and GDX was down 31 cents. So let's take a look at that chart. That chart still looks a little bit better than the price of gold, and there's nothing wrong with this chart whatsoever, especially if it stays above the 20, this red line here, the 20-period moving average, and the 50 sloping up. There's just nothing wrong with this chart whatsoever. However, gold is just not ready to take off, in my opinion, yet. So we're going to see. We're going to let the pattern tell us when the time is right to buy gold. Time and price, time and price. Oil. How about oil? Now, it was funny today because this is the USO, and oil got a little bit of a bounce today. I think the price of oil was up about $1.78, something like that. And USO here was up 33 cents. So what happens is they start talking in the media about all the tension in Ukraine and Russia again, and they link it to the price of oil, and it's going to cause, some kind of supply constraints, global supply constraints, and therefore that's the reason oil was up today. That's not the reason oil was up. The reason oil was up is because it's a technical bounce. It basically came into 35, missed it by a few cents, and it bounced up a little bit. And here's the reason why. Because if it was truly the matter that the tension between Russia and the Ukraine was going to cause global supply constraints, the price of oil would have been up $5 or $6 or $7 today. Okay, USO would be up $2 or $2.50. That's not what happened. This is just a technical bounce. So there's no way that it's time to buy oil yet. Of course, it could go higher, but I'm thinking that there's lower prices ahead. And let's go back to the weekly chart, and we'll see what happens here in the weekly. Okay, so here's your weekly chart, and you could be making a sideways, bear flag here, and then if you make the sideways bear flag, you go lower, and depending on how long that happens, that'll determine how low it goes, and that's why I'm reluctant to say whether it's this pivot low here at 34.35 or it's this one here at 34 or even maybe lower. So we have to see how this pattern plays out and what happens, how it gets to these numbers, and then we'll decide where and when the oil trade can get put on. However, I did put on a trade today in an oil company for the members, and that's safely in the money already slightly, but nevertheless, chart looks great. It's a fabulous chart. It's really what I call a delicious chart. So anyway, that one we're going to be looking forward to some nice gains there. What else should we look at tonight? Oh, I know. Almost forgot interest rates. Wow, here's the 10-year. So look what happened here. 10-year absolutely got hammered today. Okay, 10-year, 30-year got hammered today. So let's take a look. This is a weekly. Let's go back to the daily chart. It looks even worse. Right, so here you came through the lows, you just basically collapsed, and let me go back to the weekly because I'll show you what the next likely number is. If we don't bounce up back to the 200 over here on the weekly right away, we could certainly come into this. This could be considered a good pivot high at 227. But we could come all the way down in this area here where this breakout occurred at 215, even 2%. That's possible down here at 2%. So nothing yet. This is a no trade right now. However, I find it hard to believe that it'll collapse all the way down without rallying back slightly, at least back to the 200-period moving average. So there may be a trade lurking here somewhere. We'll see what happens for the members when we get there. But today there's nothing. Monday we'll see what happens, how the chart pattern plays out. Time and price, time and price, time and price. Okay, I think that's going to be a wrap for tonight. I'm David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis. Thanks for tuning in, folks.